The headline inflation number in the U.S. came in higher, but not as high as expected. The market saw the latest inflation report as a green flag for the U.S. Federal Reserve to cut interest rates at its next meeting, which is September. Let's go to Danielle DiMartino Booth, CEO and Chief Strategist at Quill Intelligence. Thanks for joining us today.
And thank you for having me.
So core CPI in July came in higher than expected. I'm wondering if this will matter to the Fed already being cautious.
I think that the market's reaction is correct. Going into the CPI report this morning, odds of a September rate cut were at 83%. Coming out of it, they were at 94%. And I think part of the reason for that is because 54% of the increase in the core CPI month over month was attributable to shelter inflation. So housing, renting came in a little bit hotter than would have been expected. But all of the news that we have subsequent to the data is that home price gains have actually now become concerns about deflation, and that rental increases are also slowing. So I think that the reason investors really shrug this off is they're saying, oh, that's just the lag effect of housing in how the CPI is constructed. That's going to come out with the wash, and Fed policymakers are going to be able to see through that.
Okay, let's talk about the impact of the tariffs. Do you feel the full effect is being reflected in what we're seeing now, or is it going to remain sort of this trickle up effect as we move throughout the year?
So I really think that how much of a trickle up effect, as you say, that we will see is going to be contingent upon the U.S. job market. Wage disinflation has taken hold, and I think we'll know a lot more after we get the producer price index in the morning in terms of how much margin is being absorbed. Right now, a lot of companies are seeing their margins squeezed because they're not able to pass through the price increases to the consumers. And of course, that's highly problematic because the more a company feels it coming out of its profits, the more inclined it's going to be to stay in a cost-cutting mode. And of course, that feeds right back into rising joblessness.
Danielle, I'm wondering why, if you can sort of fill in this blank, why some of the retailers have decided not yet to pass on any rise in cost to the consumer, or if they're doing it in a much gentler way than you would expect.
Well, again, that goes back to the idea of pricing power versus purchasing power. And I think that companies would be much more happy, in fact, to pass along price increases if they were able to do so. But the U.S. households, as we know, whether you're talking about delinquency rates, signs of distress, the resumption of the repayment of student loans, many different sources of full-time job losses were 440,000 last month. But for many reasons, American households do not have purchasing power right now, which is really crippling retailers and their ability to pass through these higher prices. I don't think it's a matter of being gentle as much as simply the retailer itself not having pricing power because the consumer does not have the purchasing power.
Got it. All right. Apart from inflation, of course, the other mandate for the U.S. Fed is employment. Do you think the American president's justified in questioning the reliability of jobs data?
I do. Perhaps the messaging wasn't ideal, but then is it ever? But in 24 of the last 30 months, and that's quite a span, 2.5 years. So in 24 out of those 30 months, we've seen the payrolls data revised downward. So there's clearly something that is endemic in the data. There's something that is systematically being incorrectly imputed in the data and needs to be addressed. This is not a new phenomenon, even though it certainly has been painted as being as much in the media because the size of May and June downward revisions were the size that they were. But again, 24 out of the last 30 months is nothing new. This is not a new phenomenon.
You say the Fed Chair, Powell, is the oddest man out in the current scenario. Can you explain a little bit more about what you mean?
Well, I think right now, many in the American public see Chair Powell as being out of step with average Americans. I think that his constant characterization of the labor market as being solid is somewhat insulting to working men and women who are losing their full-time jobs. We have the highest number of the highest percentage of young adults living with their parents, higher than any point since the Great Depression, in fact, in the United States. And that has to do with the lack of availability of good full-time, high-paying jobs. And in that kind of an environment, it really smarts, if you will, to hear the labor market is solid from the Fed chair when for millions upon millions of working Americans, it's anything but solid. Of course, I think that he'll be changing his tune very quickly here, given, again, the shock of the July labor report.
Okay, so let's talk about what's left of the year. 3 meetings left, 3 rate meetings this year. What is your expectation for rate cuts for the rest of 2025?
So I think the market's expectations of 3 rate cuts may be too low here. Last July of 2024, the Fed opted to not lower rates when the market was anticipating that it was going to do so. And in the subsequent September meeting, it ended up lowering rates by 0.5 percentage point, twice as much as what's being anticipated for the upcoming September meeting, because it was catching up to the data, so to speak. I think it's highly probable that the Fed ends up pushing through 1 larger than expected rate cut this year, in addition to 2 more, counting up to 100 basis points, 1 full percentage point of easing this year.
All right, Danielle DiMartino Booth, I do have to leave it there. Thank you so much for your time. Danielle is CEO and Chief Strategist at Quill Intelligence.